What regulations must REITs follow? Imagine owning a piece of the real estate world that offers tax advantages and steady income. How do these investment vehicles stay on the right side of the law to keep those benefits? Let's break down the main rules that REITs must follow to operate legally and efficiently. First, a REIT has to be set up as a corporation, trust, or association. If it's a limited liability company, it can choose to be taxed as a corporation. The management must be handled by one or more trustees or directors, making sure the company runs smoothly. To qualify as a REIT, it needs at least 100 shareholders starting from its second taxable year. These shareholders must hold their shares for at least 335 days each year, which encourages long-term ownership. Also, no more than 5 individuals can own over half of the shares during the last half of the year, and typically, individual ownership is kept below 10% to prevent any one person from controlling the REIT. Next, the assets a REIT invests in are tightly regulated. At least 75% of its total assets must be in real estate properties, cash, or government securities. Real estate assets include land, buildings, interests in real estate like co-ops or timeshares, mortgages, and mezzanine debt. The REIT cannot invest more than 5% of its total assets in securities of any one issuer, unless it has a taxable real estate investment trust subsidiary. Overall, no more than 25% of assets can be in securities, keeping the focus on real estate. Income is also under strict rules. 95% of the gross income must come from qualifying sources like rent from properties, mortgage interest, or gains from selling real estate. 75% of income must be from real estate-related sources. To stay in good standing, a REIT must distribute at least 90% of its taxable income to shareholders as dividends each year. This helps prevent the company from retaining earnings and losing its special tax status. REITs are required to distribute most of their taxable income annually, which is at least 90%. They cannot keep earnings from previous years or earnings from acquisitions of regular corporations without risking their REIT status. They also have to follow strict reporting rules, including federal and state securities laws. They must disclose financial details, property portfolios, and governance information regularly. For those listed on stock exchanges, additional rules apply to meet exchange standards. There are also restrictions on what REITs can do. They cannot operate as financial institutions or insurance companies. Their main focus must be on real estate activities, not running other types of businesses. These rules help keep REITs aligned with their core purpose of investing in real estate and providing steady income to investors. Following these regulations ensures REITs stay focused on real estate, remains transparent, and offer investors a safe way to participate in property markets. It's a balancing act that keeps the market fair and the investments reliable. Investors and managers need to keep a close on ownership, asset types, income sources, and distributions to stay compliant and enjoy the benefits of this unique investment structure.